Hello and welcome to a fresh new edition of Bazaar Morning Call. We are starting a new week. I'm Prashant, with me my colleagues Sonia and Nigel. Guys, good morning. You know, the question is, have we seen this movie which is about to play out before as well? What movie am I talking about? I'm talking about the fact that US jobs data on Friday came out stronger. US markets sold off on expectation that interest rates will be higher for longer. The US equity sell off aggressively, 3 to 3.5% on the S&P and the Nasdaq almost down 4%. And then here in India, you know, we start lower, sharply lower, and then recover through the course of the day. Is there a twist in the tail? The twist in the tail could be oil prices, which are at 90, almost 98, closer to 97 now than to 98, but almost there. Could this be the spoiler? So it gets a little more tricky, a little more interesting because of that. Otherwise, I mean, I would have said that we perhaps are going to see a repeat of this exact price pattern performance that we've seen for the last many months. Big reaction in US in response to a data point like the jobs report, and a very feeble follow-through in terms of selling at least, and some point market comes back up. But oil is the joker in the pack. We'll discuss about this in greater detail. Sonia, hi. Nigel, hi.
Hi, good morning, Prashant. Good morning, Nigel. And there are so many data points that we need to consider, right? I mean, we kickstart earnings season this week as well. There's TCS later in the evening. All eyes will be on that. But for starters, the global cues are definitely going to take the markets down in early opening. The SGX Nifty is indicating a very steep fall. And, you know, as we were talking about, the jobs data was extremely strong. I mean, not just 263,000 jobs that were added in September, but the unemployment rate has fallen. It's fallen to 3.5% from 3.7% in August. Proof that the US economy has not slowed enough to get inflation under control. And that's the big narrative, right? They want to get inflation back to 2%. And until that happens, rates will continue to rise. So it's that narrative that spooked the markets on Friday, and hence we're going to take that forward today as well. The market now believes that the Fed has no reason to ease off on the rate hikes. For the FIIs, they continue to sell. So FIIs sold about 2,250 crores on Friday. Let's see. For now, it's not looking that great in terms of a market opening. But then we'll take it from there. We have many cues to negotiate as well.
Earnings, right?
Primarily earnings.
Oh, absolutely. And I think that makes it interesting, especially IT, which will be first off the block, Sonia. Let me just quickly outline the most important thing. There are actually only 2 or 3 things to focus on. So the US jobs report, I'm not calling it good or bad because, I mean, then, you know, if it is good, why is it not good for the market? If it is bad, why is it, not bad? It's good is bad. I mean, that we are in that kind of a dynamic. So I'm just going to get hawkish. I mean, the September jobs report was hawkish. By the way, mind you, it's not as if the headline number was a blowout number. It was marginally higher than expectations. But what was hawkish about this was that the unemployment rate and the underemployment rate both are at cycle lows or pretty much at near all-time lows. So that is essentially why the labor market, according to this data point, remains very, very tight. And a labor market which is very tight is a problem for the Fed. It reinforces expectations that, inflationary tendencies will stay high, rates will need to move up more. 75 in November now perhaps is a given. But the problem for the market is that maybe rates will stay higher for longer. There is no pivot party, right? I mean, a quick turnaround, a quick change. But I don't think that hope gets killed. The market will continue to believe that how long will the Fed continue to press the pedal, hurt the economy? At some point, they will need to stop. So far, data shows and Fed's own actions and words show that it's not happening. We will hear from a long line of Fed speakers. This is important because, you know, most of them will react to the jobs data. And any expectation that maybe, you know, this is it and now labor market is slowing down, maybe, you know, according to some, it is slowing down a little bit. It has to with these kind of rate increases, but not enough for the Fed. So we will hear from these Fed speakers, most probably sounding hawkish through the course of the week. The next data point is the US CPI number. That is the last one before the last big data point before the November meeting. So this is going to be kind of important as well. The core number is seen on a consensus basis rising by about 0.4% or so. As I said, you know, we've seen all of this before and the market here has come out pretty unscathed. The relative outperformance is still huge in India. We're down 10% from all-time highs, but the US is basically back at June lows, right? No, we're nowhere as worse off as the US is or other parts of the world, Europe, etc. is. The only difference is oil prices are starting to inch up once again. Oil's now almost at 98. It's up 18% from the 26th of September. In the last 8 trading sessions, it's moved up 18%. It's getting closer to that 3-digit mark, which is a problem. For India, because we are a large importer, but also because if oil stays high, it basically reduces any chances of a quick disinflation. I mean, oil goes into pretty much everything, and that is a problem for central banks, not just the Fed as well. Here in India, I mean, I'll just leave you with a big number. The big one is the lows that we saw on the 30th of September, from which the market bounced very nicely. So 16,747 is that number. In a big picture sense, that is the level to really watch out for. On the upside, I mean, 17,300, I think, is something which the market will struggle to cross. 17,300, by the way, we closed around that level, is also the 61.8% retracement of the entire rise from the June lows to the recent high. So, and of course, 17,400, 17,420. So there is enough on the upside. On the downside, you need to wait and watch. The impulse, as I said, will be to try and buy the dip. Friday was a case in point where we saw that very strongly. And IT services, even though the Nasdaq sold off 4%, I think presents an interesting dynamic. It's reporting second quarter earnings. What if the commentary, etc., is not as bad? It remains the one large block in the market which is completely bombed out despite last week's pullback. So I think that is perhaps one space, to my mind, which you'd want to watch out for, which market participants will watch to try and buy, I mean, at interesting levels at different points during the course of the week, because the earnings themselves are spread out. Nigel, what are you watching out for?
Well, morning, guys. I'm getting a little bit cautious today, and I'll tell you why. Because on Friday, we saw a big intraday recovery both on the Nifty and the Nifty Bank. So it seems that the Indian bulls at least were going with some bit of hope. Maybe there'll be a bit of a miss on that jobs report. So that could be a bit of a problem, because we'll pull back all of that, as the SGX Nifty is suggesting. The FI outflows have resumed as well. Remember, the first few days in October, we had positive number. In a single day, they have turned net sellers. They sold close to 2,250 odd crores. And all the good work that was done in the previous 3-4 trading sessions, that was done away with. This FI selling is a bother for me. On the index futures front, well, the short positioning continues to remain at around 80%. Remember, prior to that, we were seeing some bit of arbitrage. That is, they buy in the cash and they short futures. Now they are short in the index and they're continuing to sell as well. At some point of time, that will catch up, but that's another cautious indicator. And on the option side, you're not getting any big direction, because they added 45,000 calls and puts both on writing and the buying side. What is the broad range then? 16,950 around 17,500. Remember, 17,500, we almost went there last week, and we saw some bit of selling out there. And the data points as well should come off you. 20, 50 DMA, that comes in that vicinity on the upside. On the downside, the hope is the 100, the 200 DMA that was recently defended, that gets defended yet again. The Nifty Bank, that's the joker in the pack for me. Remember, in Friday's trading session, we went down to around the 38,800 odd. From there, we saw a bit of a bounce, and we managed to close above the 50 DMA. So can we take support at Friday's lows? Well, that will give bulls some bit of hope. But otherwise, there are too many headwinds today. The US bond yields have spiked up. Crude at around, closer to around $98 per barrel. Dollar index at around 112.5. And also the geopolitical issues, whether you're talking about Russia, parts of the Middle East as well, that's back on the table. So how do you approach trade? Well, for me, a sustainable bounce will come only once the rupee stabilizes. You can't have the rupee go to around 83 odd and look to buy the index. So stability in the rupee, that's point number one. And the second factor is cash is a position. You're going to be going through some volatile times. And cash, if you have it in hand, you could deploy it as well. So just keep that in mind. For starters, a big gap down, maybe you get a bit of a bounce, but intraday, I think that gets sold into as well. Sonia.
And there are plenty of cues, right? I mean, we kickstart earnings season today in the evening with TCS coming out with numbers. And let's not forget, TCS has lost 18% of its value this year. So it's going into its earnings season with a lot of caution. The demand commentary will be watched very closely, considering that TCS has over 20-30% of its earnings that comes from, challenging pockets like Europe as well as UK. And the big question that everyone's asking, will the Q4 margin guidance of 25%, will it be maintained given the kind of challenges that we're seeing, the impending recession that perhaps the US is heading into? So all of these questions will be answered later today. But that's today. Going forward through the course of the week, you have plenty of numbers coming out. There's HCL Tech and Wipro tomorrow, followed by Infosys and Mindtree. And then we wrap it up with Bajaj Auto that comes in on the 14th. So lots to talk about in terms of individual cues. But let's kickstart the show. Today is going to be a difficult start to trade. No two ways about that. And we have some calls coming in. First one from Vikash Jain of CLSA, who says that the evidence shows performance reversals between leaders and laggards in the last quarter as investors possibly book out of winners. A slew of macro events over the next 2 months may lead impetus to this trend reversal. This and the big valuation premium of India equities to bonds, fear markets and its own history forces us to make our India portfolio more defensive. Vikash says we exit from Tata Steel, Hindalco, SBI and M&M. They have added Ultratech, HDFC Life and HCL Tech. Vikash says we turn to a big underweight in consumption, a mild underweight from a big overweight in materials, slightly overweight from underweight in IT and a big overweight in insurance. But he remains overweight on banks, real estate and on the energy stocks. All right, let's also get you some money market views because as we were telling you, there was a steep depreciation in the rupee and that seems to be the big talking point. B. Prasanna of ICICI Bank says better than expected US data on jobs, services PMI and a hawkish commentary by the Fed members have put the dollar back on the strengthening path. The rupee gave up its outperformance and depreciated sharply against the dollar as the magnitude of the RBI intervention reduced. B. Prasanna also says that higher current account deficit owing to a strong domestic demand, weak export growth and rising dollar against emerging market currencies are headwinds for the rupee. He expects the rupee to trade in a range of 82.20 to 83.50, weakening bias this week due to persistent onshore and offshore hedging flows. And on the bonds, B. Prasanna of ICICI Bank says the global yields hardened owing to a hawkish rhetoric from the Fed members, a robust economic data and higher crude resulting from production cuts. Further, he also adds that the global bond index providers have refrained from immediately including India, citing a lack of infrastructure. As a result, domestic bond yields are headed higher, bond supply pressure and expectations of higher inflation is likely to keep the yields under pressure. He expects the 10-year benchmark bond yield to trade in a range of 7.4 to 7.6%.
Well, we have a lot of stock-specific action as well to track today, so we'll get to that in just a bit in our special Top 10 segment. We're looking at IDBI Bank, IGL, PNC Infotech, JP Associates as well as JP Power, ONGC and Oil India. And all those stocks are on our radar. On positive news flow, let's see most of the stocks should open up in the green. We also have Tata Motors, Bandhan Bank and SH Kelkar. Their stocks are likely to open up with a bit of a negative bias.
All right, Ken Peng is now joining us. He's Asia Pacific Investment Strategist with Citi Private Bank. Ken, great to have you with us here on the program. Thank you very much. So where does all of this leave us? I mean, the jobs report, the big